Property sector profits are still growing, with average earnings up 7.3% year on year in the second quarter and 8% for the first half of 2025. But beneath those numbers, the picture is mixed. Residential, retail malls, and offices are moving in different directions, with some developers emerging as clear winners while others lag behind. Hi everyone, I'm April Tan and welcome back to Intelligent Investing Market Talk series. In this episode, let me break down the Philippine property sector's Q2 performance and answer the key questions investors are asking right now.
How did the overall property sector perform in Q2 2025?
Okay, the overall company performance relative to expectations, we had Robinson's Land and Vista Land surprising positively. Then we have Ayala Land and Philinvest Land falling short of expectations. And finally, we have SM Prime and Mega World, which performed in line with expectations. So overall, although their earnings were resilient, the divergence tells us which business models are working in this environment.
So why do you think what's happening in the residential segment?
Okay, the residential segment is still struggling. Let's start with the residential business, which is still facing challenges. So in the second quarter, residential revenues were down 1% year on year to 55.7 billion. Ayala Land was hit the hardest. Its revenues are down 13.3% due to lower booking of its non-premium segments. Philinvest also posted a 5% drop due to the weak performance of its middle income segment. SM Prime was flat, and the rest of the developers managed to show some growth, which helped offset the weakness of Ayala Land and Philinvest. So what's driving the weakness? There's an overall oversupply of residential condominiums in Metro Manila, bulk of which are those priced between 2.3 to 12 billion pesos. This continues to weigh heavily on the market. Demand simply isn't enough with the number of units that were launched over the past few years. On a combined basis, Q2 take-up sales were down 13.1% year on year. But there are some bright spots. Demand for horizontal developments like subdivisions and housing outside Metro Manila remains healthy, especially from end users and OFW families. This allowed Vista Land to post stronger take-up sales in Q2 and SM Prime to post flat take-up sales despite weaker demand for its condominium projects. Interestingly, while take-up sales were down year on year across the sector, they actually improved by 2.3% quarter on quarter thanks to the popularity of ready for occupancy and lease-to-own units. In fact, Ayala Land's take-up sales were higher by 10.2% quarter on quarter, largely led by its non-premium segment due to the strong demand for its ready for occupancy units. That, combined with the fact that interest rates are now trending lower, suggests that we may be nearing a bottoming out in residential demand. So while the segment is still weak, conditions could start to improve in the coming quarters.
So how about the malls and the retail properties? How are they doing right now?
Yeah, malls are doing quite well. So this is the bright spot among developers. So we saw mall revenues up by 6.8% year on year in the second quarter. So this is consistent with the growth in the first half of 2025, driven by higher occupancy rates, strong tenant sales, and increasing foot traffic. So one of the biggest drivers here is inflation. Remember that inflation was much higher last year, which really hurt household budgets. But in 2025, inflation has eased significantly, giving consumers more disposable income and boosting their confidence. This benefits companies like SM Prime, which is essentially a consumer play disguised as a property stock. Around 59% of SM Prime's revenues and 70% of its income comes from malls. That's why easing inflation environment is so important for its outlook.
So what about the office leasing segment?
Office revenues were up 7.3% year on year in Q2 as developers benefited from new office completions, rental escalations, and some recovery in occupancy. However, the industry is still dealing with elevated vacancy rates, largely because many BPOs and corporates continue to do its hybrid or work from home setups. On top of that, new office supply has kept vacancy rates high. On the positive side, pre-leasing activity has started to return, which is a sign that demand could be stabilizing. That's an encouraging development for the longer term because it gives developers more confidence in planning future projects. But there is one major risk to watch: the proposed Keep Call Centers in America Act of 2025 in the US. If this law is passed, it could discourage American companies from outsourcing customer service and call center operations to countries like the Philippines. And since the IT BPM industry accounts for a substantial share of occupied office space here, this would be a real headwind for the sector. So while office revenues are growing now, the outlook depends heavily on what happens in the US and how companies adapt to hybrid work trends.
Given the review that you just did, which property stocks do you think look attractive?
Given all of this, the stocks that we like are Ayala Land and SM Prime. Ayala Land because of its tilt towards the premium market. Unlike projects targeting the middle income segment, which is oversupplied, Ayala Land's focus on higher end projects gives it more resilience. In fact, 63% of its 2024 sales came from the premium segment, and about 70% of its launches are in this category. On top of that, strong sales in commercial lots have helped cushion the weakness in the core residential business. Another plus for Ayala Land is that only 4% of its revenues come from offices, which means that it's less exposed to the risks surrounding the US outsourcing policies. Finally, the stock is super undervalued. It's trading at a 42% discount to its net asset value of 48 peso per share, 41% which comes from rental properties such as malls, offices, and hotels. SM Prime is another stock that we like, even though its residential business is focused on the segment that has the most significant oversupply issue. Its small business remains its biggest growth driver. With consumer spending picking up as inflation eases, SM Prime is well positioned to benefit. And here's an important valuation point. The stock is actually trading below the estimated net asset value of its malls, which is around 33 pesos per share. That's part of the reason SM Prime launched a 10 billion peso share buyback program in December, signaling management's confidence in the company's growth and undervaluation. So to wrap things up, the property sector is still growing profits at a healthy pace, about 8% for the first half of 2025. Residential remains weak due to the oversupply of condos, but horizontal housing is doing better. Retail malls are seeing strong recovery thanks to easing inflation and higher consumer confidence. Offices are showing growth but face risks from higher vacancy rates and supply coming in, and US legislation that could affect outsourcing. For investors, Ayala Land and SM Prime look the most attractive because of their positioning in premium residential and retail malls, respectively, and their resilience against industry risks. That's it for today's update on the property sector. If you found this breakdown helpful, don't forget to like, share, and subscribe for more market insights here on Intelligent Investing. I'm April Tan. Thank you for watching and see you in the next video.